Hello friends, welcome to the NISHCHAY Series. In NISHCHAY Series, we are covering MCQs, case studies, plus numericals. Now, we are covering all of them. In fact, theory also, numericals also. So, watch the complete series. In fact, I will tell you, today I will be covering liquidity risk or liquidity management, you call it. Chapter number 27 is there, I think so. And chapter number 17 is there. 17 and 29 in your BFM. So, I will be covering both the chapters. Roughly they are similar. So, I will be covering that. Okay, various questions on it. So, watch the complete series. Okay, share it with your friends. Like this video. Okay, like the channel. In fact, I cover various questions which are repeated ones. Okay. So, let's start. And in fact, that's what I was saying, that the questions are collected from the earlier exams, whichever exams have come earlier, they are covered from that. So the questions from there I'll cover as the topic comes. To manage the liquidity risk, which of the following steps should be taken by the bank? So to manage the liquidity risk, so let me explain that point which I left, liquidity. Here, if I am having all my money in or liquid current assets in rupees only, then there is no problem, because why? I am dealing in rupees, I have to pay in rupees, everything is in rupees. But if I am having my current assets, some of them in dollars, some of the dollars I am holding, in that case what happens? There creates the liquidity risk. If the dollar rate tomorrow goes down, then, okay, these things happen. If I am the importer or I am the exporter, any cases, it's plus and minus. So I'll give you a simple logic. If I am the exporter and dollar rate goes down, then I'm in a trouble. If I'm the exporter and dollar rate goes down, okay, means $1 is now 85, let's say. If it goes to 75, then as an exporter I am in trouble. But as an importer, it's advantage to me, because there I am buying. So this is known as liquidity risk. Now this is just one example I gave you about dollars. It can be anything. It can be gold. If I am having some part of it in gold, then what? If the gold rate goes down, like right now what is happening? Where is the gold now? Gold is touching almost 85, 90 now, isn't it? Somebody who has brought gold at some 2 years back at around 50, 51. 2, 3 years back it was at around 50, 51. Now it's at around 85, 90. Almost in 2 years that person has gained what? 58 to 40, means almost 30, 40 rupees. Huge gain, 60% gains in 2 years. So this is liquidity risk. As it has gone up, if somebody is purchasing it now on 85, 90, and if the gold rate tomorrow goes down to, let's say, 60, then that person is in a trouble. Same thing. Now this was about gold, dollar. Then if I am having some government bonds, I'll give you a very simple example. If I am having the government bonds of Pakistan government, imagine I am having the government bonds of Pakistan government. I purchased it when the Pakistan was okay type, not good, it was never good. Or Bangladesh, take simple example, Bangladesh, just now this, all that changes have happened, right? So before that, if I had purchased the bonds of Bangladesh, and today these bonds are at almost scrap value, right? These are coming at scrap value. So that's why it depends what type of liquid assets you have, and that is basically the managing the liquidity risk. Okay, so I'll be coming with this explanation as and when the question comes. So to manage the liquidity risk, which of the following steps should be taken by the bank? Internal risk rate risk assessment in the banking book, manage cash flows, invest in options and swaps, set a tolerance level and limit for liquidity risk. What will you do? Or is it all of the above? Means even I can have the option of all of the above over here, right? Here. I can have this option E, all. Okay, all of the above. All. Oh my God, I am very bad in writing. Okay. E. All of above. Okay. So I can have this also. Okay, I'll give you the option E also now. We'll test both the cases. If E option is given, then what is the answer? If E option is not given, then what is the option? Okay, we'll test both the cases because question can come in any way, isn't it? So internal risk assessment in the bank, in the banking book, liquidity risk. Here, liquidity risk, you will never get it in banking book. It's hardly, I don't say never, hardly you'll get it. 99% chance there is no liquidity risk in banking book. Why? Because what is banking book? In banking book, I buy the bonds and keep it till the maturity. Kindly remember, till the maturity, I don't sell the bonds. Okay? And liquidity problem comes when I have to sell the bonds. When I am selling something, then there is a liquidity problem. So liquidity problem will always be there in the trading book, not in the banking book. There are two books in banking, kindly note. In any bank, there are two books. One is banking book, second is trading book. Okay? So this liquidity problem will always be there in this trading book, not never in the banking book. At least for your CAIIB. Practically it will be there for your banking book also. But for your CAIIB, in banking book, we don't get the liquidity risk. Okay? So this is out. A is out. B, manage cash flows. Here, what am I saying? When E option is not there, let's say this option is not there. Now we'll have to check. As per the original question, manage the cash flows. So how can I manage the cash flows? Cash flows can be managed means I can do it, but it's not in my hands always. Cash flow means what? My buyer will pay me. If tomorrow that buyer faces a problem, then what? How can I manage? Can I give that money to that person? No. If a buyer becomes default, then there's a problem for me. So this also can't be done by me. Okay? It's not in my hands. One thing what I can do is I can manage, create parallel sources. That I can do. But see here, in these four options, we have to select the appropriate answer. Appropriate means most near answer. Most near answer, it is actually this E1, all of the above. This is the correct answer. But if this is not given, then which is the nearest answer? Invest in options and swaps. This is basically a hedging method. Hedging. You can do this also, hedge. Hedge means what? Reducing the risk. You'll always have to reduce the risk of your this portfolio. Reducing the risk is always done by this options and swaps. Set the tolerance level and limit for liquidity risk. This is the most appropriate answer. Tolerance level. Now this answer covers everything. Everything. Internal risk, rate risk assessment, tolerance level. Cash flows management, ins and outs, tolerance level. Options and swaps investing, tolerance level. Everything should have a tolerance level. Every deal should have a tolerance level. Every dealer should have a tolerance level. Means there should be a limit for everyone. Limit for the liquidity risk. Every dealer, every deal, every transaction should have a limit. You can't go beyond that limit. Like this we have in a banking also, normal banking also we have the same thing. Cashier has certain limit, then head cashier has certain other limit, branch manager has powers, separate powers, some urgent cash transaction. Similarly for loans also, sanctioning the loans, BM has separate powers, regional manager has separate powers. So these are limit setting. Same thing is there in treasury also. So if you get the option of all of the above in exam, then click on all of the above. But if you don't get it, then click on the tolerance level. Okay. Which of the following is not included under the liability side management. Now not included in the liability side. Okay, not included. Kindly note, not. Always in the exam check what are they asking. They are asking for included or not included. If they are asking for not included, then you have to be very, very careful, because our mindset is such that we always try to answer the correct one. But here we want the wrong one, not included. Okay. So look at it. Not included in the liability side. Kindly note, liability side of management. So reserve position management, long-term management, capital management, and liquidity management. Liability. Which of them is not included in the liability side? Reserve position, long-term management, capital management. So what is the liability basically? Here, reserves. Okay, let me come back to the liability part. In any balance sheet, liability side, let's focus on liability. In any balance sheet, there are 4 parts, right? Current assets, fixed assets, current liability, and fixed liability. We call it long-term liability. Some books call it long-term liability. Okay. Fixed asset, fixed liability. Now here we are talking of this part. Okay, because you are seeing this reserve position, capital, liquidity, all this and this, both are we talking of this, both these parts. We are not talking of this right now, so forget this. We are talking of current liability and fixed liability. So what should be there in the liability part? Let's see. Liquidity management. Liquidity is always a short term. Now you answer me. Liquidity is always a short term. So if liquidity is short term, where should it come? Should it come in current liability or fixed liability or long term? You call it LTL. We call it LTL, long term liability. Should it come in current liability or LTL? Comment section, everyone. Type in the comment section. Where should it come? Current liability or fixed liability? Liquidity. I am starting from the 4th one. Okay, liquidity management. It will come in current liability, correct? It will come over here. So this will be CL. I'll write it over here only, CL. Let's go about capital management. Capital means what? Your share capital, you can call it. Simple. Where is share capital in this? In any balance sheet, share capital comes over here. Here, kindly note. Your fixed liabilities are of 2 types. These fixed liabilities are of 2 types. One is outside. Outside means banks. You take a bank loan, right? Are you able to see this? Or this way? Yeah, this is better, no? Bank loan. Or you issue the bonds. Take it simple, bank loan only. Term loan we can call it. Term loan. This is always a long-term loan. So this is outside. Outside means somebody else is giving you the money. And second part of this is fixed liability, inside. Inside means own money. Inside. Own money. Okay. Own money means what? Here I'll get this capital. Share capital. Capital means my own money. Plus I'll have reserves, R&S, reserves and surplus. Share capital, reserves and surplus. Then I'm having, let's say, net profit. Net profit. So that will be there. Okay. And there is one more that's called as revaluation reserves, but that's separate. Let's not get into that. So here, when I talk of liability side, I'm talking of reserve position. So R&S, this R&S. So this becomes a fixed liability, FL or LTL. Okay. Next, capital management. This also becomes a fixed liability. What is this long-term management? What is this? Long-term management is a big word. Nothing. Long term, everyone knows everything is to be managed in the long term also. So there is nothing called as long-term management like this in the finance part. I can have long-term finance management, capital management, long-term credit management, something like this. But simply long-term management, not there. So this is the right answer. You want not included. Not means this, long-term management. Everything else is included. Reserve position, you have to include it. Your capital position, you have to include it. Your liquidity position, you have to include it on the liability side. Got it, everyone? Clear? Move on. The treasury prepares trading book for which of the following purposes? Now this is an important part of your liquidity risk, trading book. Without understanding trading book, you can never focus on liquidity risk management. Never ever. Okay? Trading books here. I already have discussed this banking book and trading book. So kindly note, in any bank or any treasury or even any banking side, okay, you have two types of books. Got it? Which are those two types? Yeah. So which are the two books? Trading book and banking book. Kindly note. Okay. So trading book and banking book. So trading book means what? Here, trading book is always related to risk, liquidity risk. It is for short term, always short term. Here I purchase the bonds for buying and selling, both buy and sell. Both are done by me. I purchase the bonds for buy and sell for profit. Okay. Whereas in banking book, I don't purchase the bonds for selling. In banking book, I purchase the bonds and keep till maturity. See this, banking book, banking. Okay, in banking book, I purchase the bonds, buy and keep till maturity. Keep till maturity. So I'm not selling it at all. So if I'm not selling it, you tell me, will there be a price risk to me? Price means the price of that bond goes down. Suppose if the price of the banking book bond goes down, what is the effect on me? I'm not going to sell it. See here, price will affect you when you're going to sell anything. I'm selling this pen to you and I purchased this pen at 100 rupees. Now the cost of this pen is 50 rupees, 60 rupees, 60. So there will be a 40 rupees loss to me. But if I purchase the pen for using it over here for my daily use, I'm not going to sell it. So let the cost of this pen be 60 rupees, 40 rupees, 10 rupees. It's not going to affect me. That is banking book. Got it, everyone? Understood the concept of trading book and banking book. Very important term. Because trading book will be affected by this liquidity risk always. Banking book will never be affected. Okay, because here you purchase the bonds and keep it till maturity. Mainly here, CRR, SLR, all this CRR, SLR, this is under the banking book. CRR, SLR, they are under the banking book. Okay. So coming back, the treasury prepares the trading book for which of the following purposes? Managing the proprietary position, managing the requirements of CRR, SLR, bridging the asset liability mismatches, addressing the client related queries. Yep. What is it? Managing the proprietary position. Proprietary means what? What is proprietary? Profits. Whenever you hear the word proprietary, it means, remember, profits. Managing the profits. It means profits. Okay? Whenever you hear the word proprietary, anywhere, proprietorship, we have account, proprietorship, firms, current account. What do you mean by proprietor? The one who is there for profits. Okay? So, proprietary, managing the proprietary position means profit position. Managing the requirement of CRR, SLR. How can I manage it, CRR, SLR in trading book? You tell me. How can I manage it? I manage it. Trading book is not related to CRR, SLR. So this is related to a banking book. So this is out. Clear? Simple. Next. Bridging the asset liability mismatches. Asset liability mismatches. Asset liability mismatches means bridging the gaps between the liabilities and the assets. That is done through ALCO team. ALCO. Okay? ALCO. So that is, of course, that is a part of liquidity only. We can't remove it saying that no, this is not related to my trading book. But it is handled by the ALCO team. Here we are talking of what? We are talking of your this bucket system. What is bucket system? RBI has given you a bucket system. Every bank bucket system. Means what? You have to manage your assets and liabilities from overnight position to 5 years or even 10 years. Even 20 years is bucket system. But mainly, here, okay, let me explain you this bucket system as this term has come. Bucket system means RBI has given you, every bank, something called as buckets. Bucket means what? RBI says you manage your assets and liabilities, assets and liabilities from overnight position. Overnight means from today night. Means if I am having rupees 100 loans, asset means loans. I must have equal amount of rupees 100 liabilities also, deposit for overnight. Now same logic applies to 1 month. Suppose if I am total loans of my bank in 1 month are rupees 100, then the liability should also be 100. Same thing applies for 1 year also. Same thing applies for 5 years. But RBI is very particular here. Although it is giving you the bucket system or ALM for entire 5 years, 10 years period. But RBI is very specific about first 1 month, 28 days they call it. Very specific. Your ALM should match in first 28 days without any fail, without any changes. Means no excuses for this. Afterwards they have the tolerance levels. 5% allowed, 10% allowed, 20%, 15% allowed, 20% allowed. But first 28 days, no tolerance. Okay. So coming back, so ALM is not a part of your trading book directly. It's basically the part of your asset liability management, loans and deposits. Trading book is for profits, buying the bonds, selling the bonds. So this is out. Addressing the client related queries. Now this is a separate book. Let me come back. Okay, let me clean this. Say this. Again, I will come back to this books. Okay. There are 3 books. Means I say 2 books mainly. Trading book main, banking book second, banking book. This is the second book. These 2 I have already explained. There is a 3rd book. This 3rd book is related to client book or client related queries or client, you can call it a ledger also, client ledger. Okay. Client book we call it. So here we manage the transactions of the clients. Reliance is my client, Tata is my client, some other person, Infosys is my client. So they also purchase the bonds. They also purchase the dollars. So that transactions are maintained in this client book. This. So this is basically a ledger. Ledger means what? Isne itna liya, usne itna liya, isne. This is the amount pending, this is the amount to be given, all this. Bahi khata. That is it. Okay. So this is again not related to a trading book. So trading book means basically proprietary. This one. Managing the proprietary position. Okay. Next. When the bank deals with multiple currencies, it can take which of the following decisions? When any bank is dealing with multiple currencies, which are the decisions the bank will be taking? It can centralize its liquidity management. Now let's do this fast. This is very easy. It has nothing to do with some explanation. It can centralize its liquidity management. It can decentralize its liquidity management by assigning operating divisions responsible for the liquidity. Bank may assign responsibility for liquidity in the home currency and bank's global liquidity in each major foreign currency to the management of the foreign office in the current country issuing the currency. Okay. So which one is correct? It can centralize its liquidity management. Means I can have a central treasury. So that is right. I can decentralize. If I am a big bank, like let's say I am Citibank or SBI, then I can decentralize it. I am JP Morgan. So I can decentralize it. Okay. This country, this will handle, this country, that will handle. Okay, decentralize. And this one is also right. Bank may assign responsibility for liquidity in the home currency and bank's global Bank's global liquidity in each major foreign currency, okay, to the management of the foreign office in the country issuing that currency. Means, what does this mean, this question? It means that home currency bonds or liquidity risk. So that is managed by my head office or home office, treasury office in my home, in my country. So you call it HO, simple. Let's call it head office. So home currency bonds and liquidity will be managed by my HO. But if I am having something in dollars, I am having some bonds in dollars. So that will be managed in USA. I'll have an office in USA. This is the meaning. Foreign current office in the country issuing that currency. So I'll have that in USA. If I'm having this, let's say in pounds, so there I'll have it in UK. If I'm having something in euro, I'll have it in that, let's say France or Germany. Okay, something like this in Europe. Got it? So the answer is either 1, 2 or 3. This is the answer. Got it? Okay, next one. Which of the following is not an example of most liquid assets? Not an example of most liquid assets. Yeah? Interbank loans, securities, cash, investment in subsidiaries. Most liquid, huh? Securities, cash, investment in subsidiaries. It is not a liquid asset. Okay? Think about it. You think about it. Everyone. Okay? Which one? Yeah? Most liquid. See here. Not an example. Not. Most liquid. Interbank loans. What are interbank loans? Interbank loans means PNB giving loans to SBI, SBI giving loans to Bank of Baroda. These are always for 1 or 2 days only, generally. They can be for 3-4 months also, but generally it's overnight. Call money we call it. Call. So that is basically interbank. So this is, you want not an example. Okay, so this is true. I'll write it T over here. But I want what? I want false. My answer should be false. Requirement is false. This is true. Securities. Securities means bonds which I am holding. Most liquid. Can I sell the bonds? Of course. The rating should be there. I can sell any bond. Okay. There should be a AAA rating, AA rating. Then only I'll be able to sell it. So securities, yes. Again true. Bonds can be sold anytime. Cash. What is cash? Cash means basically the cash which I am having, money. That's the most liquid asset. Investment in subsidiaries. What is this? SBI investing in SBI Capital. PNB investing in PNB, the joint venture with insurance. PNB MetLife. Can you remove it? Today I invested, tomorrow, no. Tomorrow let's take back the money. Can you do it? Not an example. This is false. This is what you want. Okay, this is the answer. Investment in subsidiaries is not an example of liquid assets. Okay? This is a numerical here. Let's see. Okay? This numerical is not directly related to a liquidity management, but it is related to your module B. And somewhere it boils down to a liquidity management also. Okay? Let's read this, everyone. Start this. XYZ Bank has risk-weighted asset. If the credit and operation risk equals to rupees 5,000 crores, market risk equals to 2,000 crores, paid up capital is rupees 100 crores, free reserves are 200 crores, PNCP are rupees 300 crores, provision for contingencies is 100 crores, revaluation reserves are 200 crores, subordinate debt is 100 crores. Calculate the total capital of XYZ Limited. Difficult one. Huh? You have to pay attention. to this numerical. Very difficult one. Okay. See here, capital will be divided into two parts. Kindly note, capital will be divided into two parts. Mainly there are three capitals, tier 1, tier 2 and tier 3. But you can take it as T1 and T2 because T3 is an emergency capital. So there are two capitals. Capital is of two types. Kindly note, capital. You are able to see this? Capital. It is of two types, T1 and T2, tier 1 and tier 2. Tier 1 is known as free capital, free or going concern, free. This is known as paid or gone concern. Paid means I take a loan for this. T2 means loan. I take a bank loan. Bank loan is a T2 capital where I pay the interest. In T1 I don't pay any interest. It's up to me whether to pay interest or not. In T1 you have basically two parts. CET1 common equity tier 1. Okay. And second one is your AT1 additional tier 1. Okay. There are percentages for this. Tier 1 should not be greater than 7%. And it should be minimum 7%. T2 should not be greater than 2%. In this 7%, I'll write it 7% over here. This is 2%. In this 7%, it is 5.5% over here. This is 1.5%. And what are the elements now? In this tier 1, what are the elements? In tier 2, what are the elements? Let's see. Okay, what are the elements in tier 1 and what are the elements in tier 2? So let's see them. So let's do it one by one. First, tier 1 capital. Let's focus on tier 1. One second. Let's solve it here only. That's simple. Okay. So in tier 1. Now let me see which one are there in tier 1. Let's focus on them. Which one are there in tier 1? Okay. First one is, let's say, what is this? Credit and market risk. So forget this risk right now. Don't look at the risk. All the risk, keep it separate. Okay, here. Up to here, keep it separate. This will solve it later. First focus on paid up capital. Capital part. So capital part over here. Tier 1 capital, what is it? I am having tier 1. So what are the four elements in tier 1 capital? Always. The four elements in tier 1 capital are first, paid up capital. Paid up means share value. Paid up. Okay. Second one I am having is reserves. R&S, reserves and surplus. Third one I am having is net profit. Net profit. Net profit. Okay, this is all are the parts of CET1. Plus I am having revaluation reserves. Reval reserves. Okay, so these are what I am having in CET1. Common equity tier 1. These are the parts of CET1. I'll write it over here. All these are the part of CET1. These are the part of CET1. Okay. Able to see this? CET1. See this. Revaluation reserves are always taken at 45%. Means 55% discount we call it. So it is 45%. Okay. So let's discuss this only first. Then let's go to T2 later. So which one? Paid up capital 100 crores. So this will come over there. Free reserves and surplus 200 crores. So let me write it one by one. 100 crores over here, 100. So this is 100. Free reserves is 200, 200 here. Right? So this is done. PNCP. Now PNCP, where will it come? It won't come in this T1 but not in CET1. Let me write it over here. Let me show you that also. See, this was a part of your CET1. Now after CET1 we have 81 additional tier 1. 81. In 81 you have two. One is PNCP, perpetual non-cumulative preference shares, PNCP, and then you have IPDI. So forget this. IPDI means innovative perpetual debt instruments. These are the two elements in this 81 additional tier 1. Now which one is given to you? That's important. Look at this. Free reserves given. PNCP is given how much? Preference shares. So rupees 300 crores. See this. 300. So PNCP is 300. Let's write it. 300. PNCP 300. Although it is not a part of CET1, but it is a part of tier 1. Okay. PNCP done. Then provisions for contingencies. This is not a part of your tier 1. Revaluation reserves. This is a part of tier 1, but it is given as 200 crores. What did I say about revaluation reserves? Revaluation reserves are always taken like this. See this. Either the given figure, what is given figure? 200 CR. 200 CR. Okay. This is the given figure, 200 CR into 45%. Into 45%. Not either, that is separate. So 45%. 200 CR into 45%. That is 200 only, no? Yeah, 200. Okay. So 200 into 45%. So it is 90 CR. So this will be 90 CR. Okay. Net profit is not given to you. So forget it. Whatever is not given, leave it. So 100, 200 and 90. You have got it. Up till now you are over here. So this you got it. Then subordinate debt. This is a part of tier 2. T2. This is a part of T2. Contingencies. T2. These two are under T2. Anything more in T2? Nothing. Only this much. So T1 you got it all. Now first find out the figure for T1. 100 plus 200, 300, 300 plus 90, 390, 390 plus 600, 300, 690. Okay, see this, 100 plus 200, these two, then this 90, then this 300. So 690. Net T1 is what? 690. T1. Okay, T1 is 690. Now T2. What about T2? So T2 is like this. T2, let me write it. T2. In T2 there are two figures only given, contingencies and subordinate debt. What is contingencies given? In the problem only it's given, right? Contingencies. So there are two things in contingencies. Kindly note. Contingencies is not an easy task. There are two ways of answering this. One is given figure. See this. One is this. Given figure or given figure. Let me write it. Given figure. What is given? What is given is 200 CR. Either I will be having 200 CR or calculations. Second one is calculation. So what is calculation over here? Calculation. Calculation is 1.25% of RWA. 1.25% of RWA. Whichever among these is bigger, means big. Whichever is big, highest. Okay. So which one will you take? Let's see. So 1.25% of RWA. So first you will have to calculate RWA now. What is RWA? Let's look at it. Risk weighted asset. See, now we'll look at this RWA. I told you now, leave this for some time. Now we'll take it. What are the three RWAs? See this, credit, ops. There are basically three RWAs in any calculations. There are three RWAs. Credit, market, ops. Credit is given as what? Risk weighted asset. Credit and operations risk is rupees 5,000 crores. Market risk is 2,000 crores. So what is the total then? Total is, see this, I'll write it RWA over here. RWA. RWA. So three are there. Credit, market, ops. Credit plus market plus ops. Okay, all the three I'll write it over here. What is the figure? 500 and 200, no? 500 and 200. Let's see again. See this, 5,000, sorry, 5,000 and 2,000. These are the figures, right? So 5,000 and 2,000. So it is total 7,000. Directly write the answer, 7,000. Now what do you want? 1.25% of 7,000. So calculate it. 1.25% into 7,000. Do it, everyone. Let me also try. 1.25% of 7,000. What is the answer? So it is 1.25% into this. You multiply. So it is 87. Are you getting this? 87.5. Let me see. Yeah, 87.5. This is my answer for through calculations. And this is my answer through the given figure. So which one is bigger? So I'll take this one. So my contingencies are 200 CR. But there were two parts in tier 2. What were the two parts? See, one was this contingencies, that is done subordinate debts, 100 crores. 100. So take it as it is. Subordinate is as it is. No change. Okay. So subordinate debt. Subordinate. Okay. Subordinate debt. What is it given? Figure, I forgot it. 100. Okay. 100 CR. So subordinate is 100. So 100. I'll take this over here. So what is my total now? T2. Total T2 is 300. T2. So now I've got T1 and T2. T1 was what? This one. 690. T2 is what? 300. Okay, 300 CR. So what is my total capital now? Total capital. Yeah. Total capital equals to total. What was it? 690 T1. 690 plus what is this second one? 300. So it is 6 plus 3 9 990. This is my final answer. Total capital requirement. Okay. So this is my final answer. Kindly note. Very important numerical it was. This numerical comes for 5 marks in exams. If you know it, it's okay. If you know the contingencies, 1.25%, you are done. If you don't know, go on. Similarly, this 45% revaluation reserves. If you know it, 45%, then okay. If not, go on. Oh, so this was the biggest case study, right? One of the biggest case studies. In fact, this case study, whenever it comes in exam, it's too tough, huh? That's why I used to say that follow the video completely, share it with your friends. Okay? Because everyone must know this case study comes for 5 marks. Okay? Now I'll show you how to join the courses. See this. For joining the courses, go to Adda 24/7. Always go through the app. In the app, you are getting 1% extra using the coin systems. So always go through the app. Okay? Purchase this Mahapack, one of the best Mahapacks. Because in Mahapacks, what happens? You get, number one, you get, see this, I'll show you. In Mahapack, you get marathons, live classes, ebooks, test series, and right now you're getting double validity. You're also getting the recorded videos. If you miss out on something, some lecture, you can get this recorded ones. Ebooks and mock tests are to the level of chapter wise. Per chapter you are getting. So ebooks and this. Importantly, you are getting the earlier marathons also. In marathons, once you see all the earlier marathons, many of the questions are repeated from the marathons. Okay. So watch it completely, share it with your friends, and how to join? Say this. Use the code Y432. Y432. Click on enter. Look at this. 79% discount plus 1% through the app plus double validity. You buy for 6 months, you get it for 12 months. So don't miss this. And we are coming up with the crash courses also. Join those. Now, recently, immediately we'll be coming up in the next week. Okay. So don't miss that. In fact, I would suggest